As one of the most successful consumer goods companies ever, Unilever is a global titan priding themselves in sustainable growth, providing customers all around the world with a huge range of food, drinks, personal care, and home care goods. Co-headquartered in Rotterdam, Netherlands, and London, United Kingdom, Unilever is one of the oldest multinational companies, offering product in around 190 countries. They are the world's largest producer of food spreads, such as margarine. And on average, in 2016, consumers used Unilever products 2 billion times a day. The purpose of this video is to explore a detailed outline of the financial status of Unilever over the past few years, its projections for the future, as well as providing a detailed analysis on the foreign exchange risk that will satisfy any potential investors in the company. We're going to also analyze Unilever's return on equity performance, analyst recommendations, analyze their holdings, and understand the percentages of the company in foreign and domestic markets. The history of Unilever is long and consistently producing steady growth, dominating the market. But that doesn't mean they don't have their competitors. We're going to fully understand the problems Unilever faces, which is more frequent in the past few years as they acquire more facets to their business. But to fully understand the weight Unilever carries over most goods and used by the majority of people around the world, we must first understand the history that brought Unilever to where it is today. In the late 19th century, the Industrial Revolution was in full swing, and Britain was quickly replacing its farmland with factory development. This caused an astronomical growth in population and an even bigger gap between the rich and the poor. This created a shortage of butter, at the time a vital ingredient in maintaining the health of the population. This brought about a huge competition between two family businesses, which was driving the innovation of butter. The rivalry between these two Dutch families brought innovation, increasing shelf life, improving flavor, and implementing vitamins to butter. Eventually, these businesses merged, calling themselves Margarine Uni. At the time this was taking place, William Lever was building another business, in which he revolutionized how families bought their soap. He came up with a small packaged bar idea, rather than soap being sold to markets in large blocks, creating a brand ready for consumers to use. This revolutionized merchandising all over the world, appealing to the individual needs of each and every person. Then, in 1920, these two companies combined their resources, names, to create one logo, small price margin consumer-based brand, in effort to dominate the market and provide for those who need products of necessity. In the 1960s, they developed margarine to help maintain healthy cholesterol levels when worries about heart disease became a major concern. In the 1990s, Unilever tackled the fish and agriculture market, implementing sustainable initiatives to maintain the fish population and protect and ensure energy-efficient clean farmland. In 2004, Unilever's ice cream businesses, like Ben & Jerry, worked with Greenpeace to develop ice cream freezers using natural refrigerants. In 2008, they went after the laundry detergent market in Europe, developing a product allowing clothes to be washed at a lower temperature. And in 2007, Unilever began to sustainably source all the leaves that go into their Lipton tea drink and tea bags. These are just a few of many examples where Unilever shows when they invest in a particular market, they invest in contributing to its sustainability. Being that Unilever is the type of company to represent many brands, there are very few competitors that make a significant impact on their market. But there are standout companies that do compete with the industry giant. Procter & Gamble, Avon Products, and Revlon are Unilever's biggest competitors in today's market. The personal care industry is one of Unilever's best and fastest growing businesses. Their brand Dove is one of the largest name brand consumer health products on the market. And while Revlon and Avon Products are not large holding companies like Unilever, they are strong competitors in the beauty and healthcare industry. These two companies do not pose any significant threats to the beauty brands Unilever holds, but they all maintain fiercely competitive market. The main competitor of Unilever is undoubtedly Procter & Gamble. P&G and Unilever have a lot in common. They each run a global consumer goods business in control of dozens of top name brands that billions of consumers use every day. These two stocks boast similar profit margins, dividend yields, and valuations, yet the two businesses represent very different investments each with their own growth profile, brand strategy, and capital return policy. In looking more directly at each company's strategy, Unilever's growth came mostly from pushing volume and pricing gains, while P&G has to rely solely on higher prices and elevated advertising. P&G's top brands include some of the following household names, like Tide, Bounty, Charmin Ultra Soft, Gillette, and Pringles. It reports its earnings in 5 segments: beauty, grooming, healthcare, fabric and home care, and baby, feminine, and family care products. As mentioned before, Unilever sells Dove, but also Axe, Lipton, Rexona, Caress, and Ben & Jerry's. It reports its earnings in 4 segments: personal care, home care, foods, and refreshment. Revenue at all 4 units rose on an underlying basis last quarter and boosted its underlying sales by 3%. But on a constant currency basis, which is heavily impacted by the weak euro and strong dollar, it stayed nearly flat. Analysts expect Unilever's revenue to raise 4% next year. 2016 was a year of increasing progress for Unilever. Growing by the delivery of consistent, competitive, profitable, and responsible growth, Unilever once again outperformed the market predictions, with 60% of the business gaining share. Unilever has shown good quality line growth over the past 8 years, a confident, steady earner for investors. Unilever is a steady growth company, but as we see above in the turnover growth graphs, it was significantly less than in 2015. This may be attributed to the recent introduction of Brexit in the United Kingdom, which has led to a large decrease in the pound's value, which has led Unilever to raise prices despite a highly promotional and challenging environment in the UK. Although, in Unilever's annual report, they reported that Brexit will not change their commitment to a strong and thriving UK, promising they will adapt to the new arrangements. While Brexit is proving to be a difficult obstacle, Unilever's EPS has proven to show continued growth, rising 6% in 2016. In the few analyst reports out there, they all have corresponding views toward the decision-making and future predictions for Unilever. Unilever is regarded as a safe haven ADR that is consistent and provides steady growth. Last year, Unilever had parted ways with much of its margarine, the 145-year-old business that half-started it all, doing so in hopes to focus more on innovative industries, hoping to generate and increase dividend value, thus more share appeal and long-term price value. Unilever scores extremely high in price stability. Over the last year, they acquired Living Proof Incorporated and Generations, which are companies with high upside potential and innovations in the cosmetics industry. They also sold off low-earning businesses like Aid-S, a soy beverage company, which landed them $575 million. They also bought Blue Air, the leading supplier in mobile indoor purification systems. All of this was to set up for the next 5 years, to generate high returns and an accelerated delivery of value and benefits to shareholders. Despite the impact of Brexit this year, Unilever remained profitable, maintaining growth, and sustained their free cash flow. As of now, this may not be the best buy because of Brexit and how it will affect the market. Although, when that dust settles, this stock has secure long-term potential. There was one analyst recommendation on Bloomberg by Philip Gorham from Morningstar. He recommended a hold on the stock. I believe this report turnout indicates the company is in a period of stagnancy. The dividends are high and the stock is low in risk. Here we can take a more in-depth look into the details surrounding the Unilever stock. Unilever is currently priced at $50.99, down 0.62%. The chart shown represents the share trends over the last year, the 52-week high being about $51 and the 52-week low being about $38. Year-to-date change is up 24%, most likely due to the decline in price due to Brexit and selling off their margarine companies. But, as we can see, the market self-corrected, uncoincidentally right after the annual report. boosting confidence over the fallen exchange rate due to Brexit. Market cap is $152 billion. Shares outstanding is 1.7 billion. But more importantly, the estimated earnings PE ratio is 22.5, which indicates this is valued rather average, based off the share price, and the investors having a fair amount of faith given the stock's steady earnings. The earnings per share over the past 5 years has steadily been increasing, and now currently sits at 2.12, which is the highest it's ever been. The company has 627 owners. Out of that, there are 231 million shares owned. The buyer-to-seller ratio is fairly even, only 11 more buyers at 199 than the 188 sellers. Just as significantly, this snapshot image shows the insider trading taking place in the company. All of 5 are purchases. This is a good indicator of faith from within, especially after this volatile year. Here we can see P&G's stock, which is very similar to Unilever's. Their current price is at $89.60, down 0.57%. Over the last year, the 52-week high hit $92, and the 52-week low was around $79. Year-to-date changes 6.5%. The market cap was at $229 billion, shares outstanding at 2.5 billion. The estimated PE is 23.25, which, like Unilever, is fairly average. Although, P&G didn't have as hard a year as Unilever, so I expected their PE to be higher or around 20 times the earnings, which are 3.85. P&G's earnings have been very consistent, floating around the same value the past 5 years, although slowly decreasing. Between 2013 and 2016, it went from 4.05 to 3.67. This company has 3,132 owners, which is somewhat high, owning 1.69 billion. Interestingly, the number of sellers outweighs the number of buyers. We can see this data in the screen grab above that shows 62 transactions that took place in the past year. This amount of internal sales doesn't show any long-term confidence from within, and gives shaky faith in the attitude of the company. Above, you can see more clearly how similar these companies really are. This is interesting because they own and run in very different ways. In my opinion, if it weren't for Brexit, Unilever would be a better company on paper with fewer variables surrounding the next few years. But now, after understanding the negotiations Unilever has been through over the past year and how they've positioned themselves towards driving their share price, dividends, and their attitude towards Brexit, I would put my faith in Unilever and buy stock for myself mainly because of all of this considered, as well as their insider trading trends. This company has survived, thrived, and consistently grown through revolutions, recessions, and crises all over the world. They align themselves with the innovation of the future, which is one of the most profitable ventures in the world today. Thank you for watching.